Good afternoon, everyone. My name is Rahul Rishi. I am a senior member with the blended finance practice at Nishith Desai Associates. A very warm welcome to today's session on blended finance structures to scale up climate smart agriculture. This session builds on the groundwork that was laid during our earlier discussions in Alibag with Mr. Jayan Sinha, where we had discussed scaling up a promising stream of climate adaptation in agriculture. That dialogue brought together a diverse group of stakeholders, financial institutions, investors, philanthropies, and sustainability experts to explore how strategic capital and partnerships can promote climate smart farming solutions. Since then, we have seen growing momentum and commitment towards financing technologies that enhance climate resilience to farmers. However, to truly scale up to truly scale up what works, we should move beyond grants and pilots. We need structures that blend philanthropic, public, and commercial capital in a catalytic and sustained manner. Today's session focuses on five such blended finance models that has the potential to unlock impact at scale. We'll hear insights from industry experts who have worked on such models before, and I will also be sharing brief legal and regulatory reflections after each session, especially around the design considerations, structuring issues, and what are specific legal and regulatory compliances that we need to factor in. We are joined in by a wonderful line of speakers along with my colleague Seher Sharma. She's an integral member of our blended finance team, and she'll be taking us through to the legal and regulatory aspects on various models that we shall discuss here today along with our esteemed list of speakers. Uh, Without much ado, I'll quickly introduce our speakers. So our first speaker is panelist is Mr. Ganesh Neelam. He is the executive director with Collective for Integrated Livelihoods Initiative, CINI. Then we have Miss is lead impact financing, and she is with Villgro Innovations Foundation. And we have Kritika Kumar. She is senior advisor with GIZ India. Let's begin. So the first point of discussion we have here is in the context of Lakhpati Kisan and the case of blended finance. And we have Mr. Ganesh with us who will take us through to the contours of what Lakhpati Kisan initiative was all about. Ganesh, let's begin with the Lakhpati Kisan program, which was introduced to identify a scalable approach to strengthen tribal livelihoods and boost economic opportunities for smallholders. And I think for a larger audience, it would be great to uh, understand more details about what this program was all about, how was it executed, and we would be, it would be great to hear insights from you. Over to you, Ganesh.
Thanks so much, Rahul. If I can have the presentation on. So this basically is a program which we, along with the support from Tata Trust, had initiated in the year 2015. I would say it was one of its kind in the year 2015, wherein we were trying to see if the small and marginal farmers, mainly in the backward and tribal regions of central India, with the resources that they have, which is agriculture, livestock, and in some places non-timber forest produce, can earn an income of more than ₹1 lakh on an annual basis. And this was mainly the hypothesis which came along with the communities on the ground, wherein they were expecting a reasonably good return from the livelihoods that they are dependent on. So the Lakpati term is also something which came from the women when we were discussing and dialoguing with them. And over the years, the program has evolved from looking at how the community's livelihood could be strengthened, and we bring in the climate resilience angle to it in a systematic manner. So if you look at the key principles of the program, it is mainly emphasizing on women-led institutions. So we also looked at how we can build on the NRLM structure and further strengthen those structures from a livelihood perspective. Also look at creating new institutions like the farmer producer companies, which are not part of the NRLM structure, but they make a lot of sense when it is a business-based engagement for the rural and tribal communities. The second important piece, I think, for which all of us are here together is in terms of how do we imbibe the climate resilient practices and technologies. Our partnership on Sustain Plus with IKEA Foundation actually helped us integrate a lot of focused renewable energy technologies in the work on agriculture and allied livelihoods. And that brought in the strong emphasis on climate resilience at the community level. And the third important piece, I think all of us know, these communities do not have only one single livelihood that they depend on. How do you look at that layer and work with them to understand the pain points in that layer and see how we can address those livelihood layering issues from the family perspective, which also in a way gives them an ability to manage risks and also see the income increase in a systematic and substantial manner. And in this whole premise, the program, when we had designed, it had a particular amount per family as an investment that had to go in to achieve that outcome over a period of 5 to 6 years. And we basically were looking at like-minded partners to come and join hands to make that investment per family to see that outcome, in which we also have been trying, I would say we still continue to try, on how we can bring in financing for these small and marginal farmers to achieve that outcome in a systematic manner, and they are able to build in or adopt to new technologies in this whole journey. That's been the larger approach of the Lakpati program. If we can go to the next slide, please. This is again, as I was sharing about the work on the Lakpati program and our opportunity to integrate different technologies at the farmer field level. These are something we call as climate resilient production hubs, wherein you are able to look at the whole value chain, be it in agriculture or livestock. And in those value chains, how do you integrate technology at the relevant place? Like in the pre-production stage, if you look at the right-hand side, you have a polyhouse nursery, which is providing healthy saplings as a service to the farmers. The second important connection is the drip irrigation based connection, wherein we are also focusing on water management. In this, the mulching is now also something that we are proactively looking at. Biodegradable mulch could be brought in from the soil health perspective. Again, as I was sharing, our partnership with IKEA Foundation through Sustain Plus is wherein we were able to integrate decentralized renewable energy into the value chain at the production stage, as well as at the pre-production stage, and finally also at the post-production stage. Now, these are important, I would say, technologies which enable the small and marginal farmers to strengthen their livelihoods in a systematic manner and in a long-term manner. But these technologies do need investments. And those investments, what our learning has been, the philanthropy or the CSR-based donors can bring in a certain amount of investment. The community will contribute a certain amount of investment, but we surely need a certain blend of financing which has to be brought in so that this becomes something which is much faster scalable rather than always depending on grants to implement program. And that's been our learning on the ground as well. And the financing challenge, as I said, still continues. We are trying to work with like-minded partners like Nishith Desai team as well as GIZ to see how we can build that up in this case to look at. Next slide, please. Again, just as an example, how financing actually can help strengthen those entrepreneurship and enterprises within the larger ecosystem. This is just as an example, a polyhouse nursery entrepreneur who actually is looking for some such financing coming in for him or her to take that livelihood as a service delivery for the larger community. Now, if you are able to bring such integrations within the value chain, you are surely ensuring that the value chain is strong and the community institutions are able to manage that value chain in a systematic manner. Here, financing plays a very important role. We did work with some of the financing institutions, both banks as well as non-financing institutions, but we very clearly see at least a 50-60% financing support coming in for such enterprises or entrepreneurs will enable the chain to continue on a long-term basis, and it would not only be depending on say, funding to look at. Next slide, please. Examples of how the financing opportunities could be built up, and this is again based on all the work that we have been doing on the ground vis-a-vis various technologies integration to build up through the Sustain Plus program, through the Lakpati program integration. We try to basically also try and see if we can bucketize and create some say loan models or loan products wherein financing can basically enable that particular livelihood to grow in a systematic manner and also grow in a faster pace. We all know that we need these type of interventions to be done at a scale, at a very faster pace, and it cannot always be on a slower pace with only depending on grants. So how do you look at those mechanisms is something that we were able to try and bucketize or club from different particular technologies which we have experimented on the grounds, be it drip irrigation, be it solar-based irrigation systems, be it mulching, be it polyhouse nursery, be it biodigesters. We have all experimented them on the ground. We are seeing a lot of demand from the communities. But how blended finance actually can help us achieve the next level of scale is something that I think all of us should keep on focusing and trying. And this is what we are trying as well as a team. Last slide, please. I think last slide at my end. As I was sharing, these are again field level experiences. I'm not talking something which is only in theory. This is something that we have been doing on the ground. We are seeing a lot of opportunities as a demand from the community. The technology players are also ready to see if they can meet the demand as well as the after sales. Financing as an add-on will really push it to the next level. And that's what I think all of us are expecting, at least a 50-60% financing mechanism with a blend of, say, philanthropic money is something that we are proactively trying to look at. And in all of these, the communities are contributing. So it is not like 100% support that goes freely to the community. They are contributing nearly 20-30% also as an investment from their side to the technologies and the livelihoods to look at. So
Right.
next slide, which is the final slide, and just a photographic based understanding. So these are just some photographs from the field with the small and marginal tribal families. With the increase in income, with the adoption of these technologies, they have been able to meet some of their aspirations of buying two-wheelers. The women had an aspiration of having a two-wheeler at their end with them. But after a period of 5 to 6 years, we could see that they are actually able to purchase a two-wheeler, which means there is really an increase in income, which they are also visualizing with the adoption of the technology. So this is where I would stop, and thank you very much for the opportunity, and look forward to the discussions. Thank you.
You have very, largely covered what all the the Lakpati Kisan program brings in. So it will be helpful to understand, are there any key learning or key challenges that you've faced during the implementation process that you would want to share with us?
Shahar, from a learning perspective, and it's a journey that we still continue to learn with the communities. Certain things that we are learning as part of this journey. I think financing is one which I was emphasizing on. The second important learning that we are getting is with the technology partners, and if they are looking at the communities as one of the opportunities to expand their technologies or businesses, how do we also build in an opportunity for the technology players to make investment with these institutions to build their capabilities as well, rather than only looking at them as a conduit to pass through the technology? How does one also look at building capabilities within these institutions? Because I think all of us know these are small marginal farmers. They have come together, mostly illiterate, semi-literate. There is surely a strong focus that needs to go to build their capabilities also from a growth perspective, which will also help a lot of these technology partners to grow their businesses in the area. And the final point, which continues to again be a challenge, is on markets. On how do we ensure that markets are able to respond to the communities? What are the producers that they are bringing? Market is able to give them a better price. How do you negotiate with the market ecosystem? Still continues to be a challenge, Sahir.
Right, I understand. I mean, this is where all the structuring matters, like how to manage different stakeholders, what are their requirements. From a legal perspective, also, look at different angles as to, from a donor perspective, like if it's a CSR funder, they'll be worried about their CSR compliance. You've also been working with government funders, so they again have different limitations. So do you want to maybe
मेरी लैपटॉप हैंग
briefly
कर रही है.
touch upon how you manage to bring in all the funders together, and how these small farmers, they also bring in some capital. So how does that work, and are there any challenges you face there?
So basically, again, because we are a non-profit, and we also we depend on grants to do our work on the ground. What we have been learning is the larger funding ecosystem is also evolving and changing a lot. Uh, some philanthropies are open to support from a long-term horizon. They are fairly open also from the type of funding and the support that has to be going on the ground. But there are, like, for example, CSRs, there are challenges vis-a-vis the compliances and other aspects, wherein it becomes difficult to get support from the CSRs on a long-term basis, and also to get support on, say, maybe like, for example, the farmer producer company strengthening, or their whole ecosystem strengthening. There are difficulties of having investments on those particular technologies or support systems to the institutions. The second that we have seen from a funding perspective is government has its own schemes and programs. Those again have a lot of other challenges vis-a-vis mobilizing them on time and seeing that the community benefits from it on a timely basis. What our learning has been, the ecosystem is also evolving, and in that we are seeing that some of the players in the funding ecosystem are very open. We are able to work with them, able to grow with them on the program and the outcomes at the community level. Some are fairly conservative, which becomes difficult for us to maybe take things into action in a systematic manner. So broadly, that's how I would basically put it across here.
Great. Thank you, Ganesh, and sorry for my short absence.
No worries.
I
No worries.
had some issues. So I think this was a great insight, Ganesh. We'll, in the interest of time, we'll now quickly move on to our next
Yes.
panelist.
Thank you very much.
Thank you so much, Ganesh, for your insights. We now move on to our next topic, which is partial product subsidy model, and we have our esteemed speaker, Ms. Risha Goel from IKEA Foundation. Richa, over to you for your reflections on using partial subsidies centered around enabling access to renewable energy.
Thanks a lot, Rahul. Can I just quickly confirm if you can see and hear me?
Yes, loud and clear. Yes.
Okay.
Please
Can you
go ahead.
please pull up the slides?
Yes, yes. Mukesh, can you put the slide for everybody to see?
And as Rahul is pulling up the slides, hello to everyone. It's a real pleasure to be here. By way of introduction, I'm Richa Goyal. I work at IKEA Foundation. We're based in the Netherlands. And I'm part of the renewable energy team, and I manage a portfolio of grants focused on enabling access to productive use of renewable energy in sub-Saharan Africa and India. So for this presentation, I was asked to speak about blended finance and its role in enabling partial subsidy and unlocking the wider pure ecosystem that Ganesh in the previous presentation was alluding to. So I thought maybe I'll start with a very simple definition of blended finance for all of us to just come on the same page. And I know there are many finance veterans here who don't need to be explained what this is, but just to align ourselves. So as you can see in the slide, blended finance is, or typically in a blended finance pool, you need some form of public capital or philanthropic capital to crowd in private sector investment. And the idea basically is to enable achievement of sustainable development goals or climate impact. And the role of public investment or philanthropic investment, and as in our case at IKEA Foundation, is to de-risk the investment for the private funders and to maybe even improve the risk return profile, as in a lot of these impact investment blended finance initiatives, the return profile is not according to market returns. So that's the main objective of blended finance. And on the right-hand side of this picture, I found this graph in the Convergence Report, State of Blended Finance 2024. It's a nice report, you can look it up. But I found these archetypes on the right really useful, and I'll give some examples of that from our portfolio on how we at the foundation are trying to leverage blended finance for unlocking partial subsidy or enabling partial subsidy for productive use of renewable energy. So you see that, so grant, for instance, can serve the role of first loss capital, and then it can unlock more senior debt or equity from more commercial funders. It could serve the role of guarantees, which can be placed within banks, for instance, so to unlock funding for some of these perceived high-risk sectors like farmers. It could also provide the role of TA facility. Even that would count as blended finance from this definitional point of view, because TA, if it's delivered in the right way, or technical assistance, it can help lower the cost or the transaction cost and help de-risk some of these investments. And therefore, it can help reduce interest rate as well. Then of course, and then there are the traditional way the grant is deployed. Yes, for any kind of programmatic design, and once grant starts to exit, hopefully debt and equity starts to come in. Next slide, please. Thank you. So here, so that was blended finance. But for the purpose of this presentation or this webinar, we are focusing on demand side subsidies or end user subsidies. So how does blended finance link with the more demand side capital that's needed to unlock consumer lending? Because as you're all well aware, renewable energy is expensive. The upfront costs are very high, and so and especially when it's targeted at more vulnerable groups like smallholder farmers, then you have to enable end user financing and easy payback periods. And so you have to work with banks, but banks perceive these customer segments to be of higher risk. They may not have the right credit histories, collaterals, etc. So you need to maybe enable some underwriting processes. For all of these purposes, you need grant money to kind of help start unlocking financing in these sectors. And so if you look at the demand side subsidies part of this capital spectrum, you can pretty much divide in the different kind of interventions in three broad categories. It is cost reduction, which is again partial subsidy to the extent the cost reduction is happening of the capex on the renewable energy product. There you could do some structural changes in cost of payment terms to match the cash flows of the smallholder farmer, for example. You could do risk mitigation for loan enablement with the use of, for instance, first loss or guarantees. And so what I've done here is I've listed, and again, I've given some examples of how you might do cost reduction, for instance, by way of direct subsidy, uh, like how we are doing in the Sustain Plus program. Ganesh was describing some of these aspects previously. Or you could do interest subvention, help lower give some kind of capital relief to banks and help lower the interest rate on the loan being given to the farmer or other groups. And that way it helps lower the cost of loan. It also acts as an incentive for greater technology adoption in early phases of a tech value chain. Um, on the structural change in cost or payment terms side of things, you of course have to again vary that to match, because there is the seasonality effect for farmers and other kinds of shocks that may be external to what we are trying to do with the farmer. So you have to kind of match those cash flows, and therefore you have to change the payment terms accordingly. On the risk mitigation side, I mentioned things like first laws, guarantees are quite typical. Again, this is not an exhaustive list. There are many other kinds of interventions you could do across the three categories. These are just examples of how we are involved in sub-Saharan Africa and India. And then again, there are some examples I've listed from our portfolio. Again, these are not exhaustive examples from our portfolio. There are many other things we are trying to do, but just for the purposes of this webinar to kind of elucidate, in what kind of different ways of philanthropy or a CSR or the various kinds of donors could step in to help move things along. So on the cost reduction and structural change side of things, we have two programs that we're supporting in India: the Sustain Plus program that Ganesh was describing before. There is the Powering Livelihoods program that we are doing with Villgro and CEW. In both of those programs, there are some kind of partial subsidies involved, and I won't go into the details of a lot of the details, but for instance, interest subvention is something that both these programs are using quite effectively, where the last payment is essentially waived off, but that helps enable some payment discipline from the borrower. Again, cost reduction is more interventionist. It should be ideally targeted to more vulnerable groups. It requires more targeting from a subsidy mechanism. If you do targeting well, then there is less market distortion. And I think Sustain Plus program particularly is really good at targeting because it has that support from it's done with CINI and Tata Trust, where they've been involved with some of the vulnerable groups like different tribal populations for a long time. So they kind of understand the space. They know how to kind of target these subsidies well. Yeah, so on the structural change in cost and payment terms side of things, again, because you have to first do some, sorry, the slides have disappeared, if you could bring them back. On the structural side of things, you have to do a little bit of, I don't want to use the word experiment, but you have to figure out what the cash flows are, to be able to structure the financing model. So you don't want to start with a very large scale program at once, but you want to maybe start small before you move on to replication and scaling. So, but all of this required grant capital. So you can figure out the terms of the loans and what different customer segments are and how to structure the financing. So that's where the partial subsidy and the role of philanthropic capital can come into play before you start to work with the banks more formally and at a larger scale. Then on the risk mitigation for loan enabled side of things, we have a number of initiatives. In India, we have two different grants with Rabo Foundation, where we are working with a few NBFCs in India, and where we've placed because Rabo Foundation, because of its experience with the Rabo Bank, they have a lot of experience in structuring guarantees. And they've been working with the MFI sector in the agri space for a very, very long time. So they have a lot of experience in it. So they were an interesting partner. Shell Foundation is also involved. And they, so we're working with few NBFCs in India, like Samunati, Avanti, I think there's Caspian as well. There are a couple of others. Yeah, essentially placing guarantees to help them, give them a little bit of comfort and help de-risk their loans and get them to lend to FPOs, women-based renewable energy startups, cooperatives, farmer cooperatives, etc., etc. And that's a long-term program, about 7-8 years. So we'll see we're right now in the middle of the grant. We'll see that what success it has brought in. Are the guarantees still needed? Do we need a graduation approach after the program ends, as we ease out the guarantees and let the banks start to do more formal lending on their own without the guarantees? There's the Green Genset facility, which started with a small pilot in Nigeria, where there are millions and millions of diesel generators in use. And so because that was a very unique situation, because these a lot of people were using diesel generators and they had a very high OPEX. And so in this case, it was the case of just switching out a tech with a diesel generator with, let's say, a solar generator. And so then the only intervention that was needed was to set a solar generator as a formal asset class. And so then on the back of those interesting learnings, we helped spin off a facility of its own called Green Genset facility. You can Google it, which acts like a trading company, helping with local distributors in Africa source solar generators and therefore help with working capital of local distributors. And then local distributors can help with financing to end users. And therefore, in that sense, it kind of acts as a partial subsidy. My last example, and this is also my last slide, is G4A, or Green for Access, where we are working via class through different entities. One is GreenMax and one is Charm Impact. There, what we did was we literally, because in countries in Africa, unlike India, you don't really have priority sector lending in many countries. So a lot of the banks don't have that mandate that you have in India. So here we placed some cash deposits with the banks that would serve as first loss via GreenMax, and that in theory is at least expected to unlock consumer lending. These are just some examples. If there are questions, I'm happy to take them later.
Sure. I have just one question for you, Richa, and I think maybe we'll take another 8 minutes along with the legal and regulatory part that Shahar will be covering. So I have one quick question for you. So in your experience, how do you determine whether a product or solution is ready for a partial subsidy model, especially in the context of productive use of renewable energy? And how do you ensure that partial subsidies act as a true market enabler than distorting long-term pricing expectations among farmers and suppliers? If I can have 30 to 40 seconds on that for you to answer, and then we'll move on to the regulatory part. Thank you.
Thanks, Rahul. So you asked me two questions for 40 seconds, so I
Yeah.
don't know.
Okay, take a minute, please. Okay.
Yeah, but on which product to give subsidy for? Actually, all products need subsidy because A, it's
Right,
energy
right,
sector. Energy requires subsidy. Renewable energy especially requires subsidy because there's also the transition
right,
element and higher upfront cost. And in general, the pure subsector is very, very nascent. So all of these appliances, even if it's solar water pumps, which is probably more
right.
mature compared to some other productive use, requires a lot of subsidy. That's why you have the KUSUM program in India. So I think for us, it's a little bit contextual. It's more about what kind of subsidy is needed and for what kind of periods, and there the expertise of partners come into the play. I won't speak more because there is time. You have 40 seconds, so but I can add more detail later.
Right.
And do you
Yeah.
still? I forgot what your second question was, or do you need me to stop here?
Just maybe quick bites on, how do you ensure that partial subsidies or blended finance act as a true market enabler than distorting long-term pricing expectations among farmers and suppliers?
Yeah. So here, because it's blended finance, so the at the very outset, it is that you're hoping to crowd in either uh, you know, commercial banking funds or other kinds of forms of private investment. So a lot of these grants are structured that way. So first of all, start small. Don't immediately do a large scale program because of
Right,
you'll often have learnings and then you'll change things along the way. And in
right.
some of these examples, yeah, there is exit different kinds of graduation approach and exit strategy. Again, I can add details later, or please feel free to reach out to me
Sure.
separately.
Okay. Thank you so much for your insights, which I'll quickly move on to Sahar to take us through to legal and regulatory considerations that we need to be mindful of. And Sahar, please take not more than 120 seconds to cover it. I know I'm a little short on time on this, but kindly cover these points as efficiently as possible. Go ahead. Yeah.
Sure. So Richa has touched a couple of blended finance models in what she was saying. So she has talked about a first loss guarantee model. She has talked about returnable grants and other models. So maybe we are discussing those models in our subsequent speakers will be touching on that, and then I'll discuss the regulatory aspects related to that specific model then. So, with respect to blended finance models, what we need to understand is that blended finance models can be structured as per the commercial requirements of what is your, the target population that you're targeting. For example, if it's a farmer, then what is the problem that you're trying to solve? That comes in the structuring part. Like, for example, in case of a partial product subsidy, what essentially happens is that, like Rita said, right, that these renewable products, they are very expensive. And what happens is that the donors, they, give some sort of capital to these vendors who might, then lower the price of the product for the farmers. Now, in doing so, there are different structural elements that are important, like, for example, for the donors. If it's a foreign donor, then a different set of regulations might apply. Because if it's a foreign donor, then it is very important for them that the foreign funds that they are donating, it should be to an FCRA registered entity. So when I say FCRA registered entity, it's so there's a Foreign Contribution Regulation Act under which any person or individual or Section 8 that's receiving any sorts of foreign funds, it's important that they have a FCRA registration under this act. Now, this is one example. For example, if it's a CSR donor, then they'll have some different requirements, right? Like, for example, if I'm a CSR donor, the most important thing for me would be that I can only give my CSR funds to an implementing agency. That's defined, in the CSR rules, and that can only be a Section 8 society or a trust which has a 12A registration, or a Section 8 society or trust which is, set up by the government itself. So these are some of the main implications. It depends on how you structure the product and what are the requirements, but it should be made sure that they're in compliance with what the donor requirements are and where the product is being used. Like, for CSRs only. It's important that the activities that are using that the CSRs are using their funds for are covered under, Schedule 7 of the Companies Act.
Thank you, Sahar, for taking us through to the legal considerations. So we'll now quickly move on to our next topic, which is credit guarantee structures. And our panel speaker for this is Mr. Jay Kumar Gaurav from GIZ India. Jay, we look forward to hearing your experience on structuring guarantee schemes. Over to you. Thank you.
Hi, good afternoon. Am I audible?
Yes, loud and clear. Please
Okay.
go.
Thanks, Rahul, and good afternoon, everyone. So I'm Jaikumar Gaurav. I work for GIZ, which is German International Agency, and we are developing. We have already implemented a risk sharing facility with Small Industries Development Bank of India (SIDBI) to provide partial debt guarantee for waste sector entrepreneurs. So we started in 2022 with the launch of the guarantee, and so far we have provided guarantee to 7 waste sector entrepreneurs. And the corpus of the guarantee is basically a grant that has been given by GIZ to SIDBI, and it is there with SIDBI on the basis of which they provide guarantees. So it's a complete cash guarantee, and we provide up to 50% guarantee on the loans that these waste sector entrepreneurs take. So this 50% guarantee is enabling these waste sector entrepreneurs to reduce the collateral requirement on their loan. For example, if you're applying for a loan of 10 crores and the bank will ask for 100% collateral. And this is the case for almost all the waste sector projects, agriculture sector projects, because banks consider these sectors as very risky, and the asset generally for which you are asking for a loan is not a very liquid, or it cannot be sold very easily, and therefore it's not possible for the banks to recover the loan amount by sale of assets in case there is a default by the entrepreneur. So these guarantees, they have helped mobilize around 30 crores in loans for these 7 waste sector entrepreneurs. Some of them are very small loans, and some are larger loans, like up to 12 crore in debt is what we guarantee. So our guarantee is 6 crores for a 12 crore loan. What we have realized is that even when the guarantee is available, there are challenges in terms of mobilizing the remaining collateral, because sometimes the assets are valued at a very low price, and this would be the case with examples that were shared by earlier speakers, like these small solar units, or the sprinkler systems, or uh, the uh, the grow nets that were presented by the first speaker. So in our view, guarantees are very important instrument, and they can enable a lot of financing for these risky sectors, or sectors which are considered risky by mainstream financial institutions. And our experience has shown that guarantees really work. We intend to replicate this model for agriculture as well as for other sectors where the need for debt financing, and entrepreneurs or farmers, they are not able to mobilize debt because banks consider those loans as too risky. Another issue that we've found in case of guarantees is that our guarantee is limited to 50%, but we have found that guarantees up to 70, 80% can be better, because it is really challenging for very small percent. Of course, 100% guarantee won't be suitable, because then there is no risk no risk for the entrepreneur, or you are taking entire risk, and then the amount of money that you would be able to leverage because of the guarantee facility would also be limited. So higher level of guarantees, then we also realized that charging a higher fee for providing the guarantee, like for instance, other instruments, they may be charging 2%, 3% guarantee fee. That also discourages the entrepreneurs to go for guarantee support, or even apply for the loan, because the loan is already priced at 8 or 9%, maybe sometimes 10, 11, or even higher. And then you are paying 2-3% for accessing the guarantee, then the cost of borrowing increases significantly. So in our case, we are charging 0.4% guarantee fee, which is quite less. And at the same time, it helps in providing financing for covering the administrative cost, covering the overheads, so to say. So our experience has been quite good with this guarantee facility and working with Small Industries Development Bank of India, SIDBI. We intend to replicate it in the agriculture sector and new projects that we plan to develop. And yeah, I look forward to any questions you may have on guarantees.
Great. Thanks. Yeah, there are a couple of questions that I thought I should pose before you. So the first one being, many banks hesitate to lend to small farmers or FPOs or agri enterprises. So how exactly does a guarantee scheme help build their confidence? And what are simple ways to design a guarantee so that it's easy, for entrepreneurs, banks, and donors to use that template?
Sure. So you're absolutely right that banks find these sectors very risky, and rightly so, because there have been cases of NPAs or due to the past record of the sector. So once you bring a guarantee instrument to a sector which is considered risky, at least it takes care of a very large extent. Like in our case, it is taking care of 50% of the principal amount that the bank is giving to waste sector entrepreneur, and in your case, it could be a farmer, FPO, or agriculture, small agriculture based unit. So it is giving them a comfort that okay, at least 50% of my principal is secure. And then the other thing that really helps in case of a guarantee is that it should be first loss, and also it should be like once you know that a particular account has gone NPA, the bank should be able to get the 50% guarantee or 70% guarantee, whatever is in the design of the guarantee instrument, as soon as they can, basically. So they know it 3 months have passed. In India, it is 90 days. So if a farmer or an entrepreneur has not paid their EMI for 90 days, then you declare them as an NPA, that account as an NPA, and then the bank can ask for that 50% guarantee or 70% guarantee amount to be transferred. Then they will start some kind of recovery process, restructuring process. And in that, if there is a good amount of recovery, then maybe the guarantee amount which is in excess of 50% can, or basically which is after recovery, it is leading to a certain excess, then it can be returned. Or if it is not leading to an excess, then the guarantee amount stays with the bank, and they are able to safeguard their losses. So that way, I think if you design a guarantee which is very straightforward, and the bank can see that you have the money with the guarantee instrument implementer, and it's not just a guarantee that will be mobilized or will be will be conditional to multiple steps or procedures. So easier application process for the guarantee, easier application for revoking the guarantee, for asking for the guarantee cover, is what can really help in building the trust in the banks and financial institutions, NBFCs, MFIs, in terms of accessing the guarantee. Because you can imagine they're paying a small fee for recovery processes to be completed, and then only you can access the guarantee. So that kind of takes the confidence out of the mechanism, and therefore it is important to have guarantees which are easily accessible, which are very clear in terms of how the money has been allocated for the guarantee, who will pay. There are guarantees which are by very large financial institutions, and it's not like an allocated sum lying in some bank account, but it's the general company level guarantee, which are also getting implemented quite well. So, not saying that it's a necessary condition that you should have FD or cash in the account exclusively for guarantee provisions. But overall, I think in our case, it has really helped in building the confidence among the banks that okay, they have the money, it is lying in this account, and in case there is a default and there is an NPA, these 2 3 steps we have to take, and we will be able to access the money. And then the limited guarantee fee also helps. That it's 0.4%, which is very nominal
Right.
fee to access the guarantee.
Thank you, Jay, for sharing your insights with us. I simply would request Sahar to go on to the legal and regulatory considerations, and Sahar keep it slightly shorter because we are running a little short on time. Over to you, Sahar. Thank you, Jay.
Thanks.
So for the credit guarantee models, the issues are basically the places where the legal and regulatory considerations come in. Like it's very important as to how do you decide what, how much, if it's a first loss model, the extent like Jay said that for them it's 50% that they cover 50% is their guarantee. So the amount, what amount you decide is something that should be explicitly covered in the agreements beforehand, so that there are no problems later on. The trigger events as to when the guarantee is to be triggered, what are the precautions that the bank has to take, before triggering a guarantee and telling the donor to, maybe reimburse them for their default or the loss of the farmer. So that's another important thing that should be considered. Now, with respect to the funders, an important consideration again, like Jay said, the most common model is that the donors put it in some FD with the bank, and so that the bank have some sort of comfort in, giving that those loans to the farmers, that they'll get some amount back in case. But again, here also it depends from donor to donor. Like if it's a CSR donor, it will be very important for that donor, that CSR donor should first give those CSR funds, which to an implementing agency, which can later be used, or given to a bank and kept under as an FD, and then the
Right.
CSR funder can get the outcome report.
Right.
So again,
And
restructuring for these
Sahar,
funds varies.
Sahar, if I may have additional questions here. So, what are specific FEMA or NBFC related considerations that we also need to be keeping in mind? Just
Right.
a one or a two line I
So
would have.
yeah, so important consideration here is that when, if for example, there is the bank is not involved and the donor is themselves giving in some money, and it's an NBFC, then it should be made sure that the interest that they're giving is as per the RBI norms and as per the priority sector lending norms. Otherwise, this might trigger some violations. And for FEMA also, it is very important that if there are any foreign funds coming in to an NBFC via an ECB route to maybe a Section 8 or any microfinance institutions, then the FEMA restrictions are looked at, and they are carefully captured in the agreements.
Understood. This is helpful, sir. Thank you for your inputs. Uh, and thank you again, Jay. We now move on to our next topic, which is returnable grant. And we have our esteemed speaker, Ms. Priya Naik. She heads Samhita. We all know Samhita, and she's been quite active in this space. Samhita, along with few uh, implementing agencies, have tried out different models in the past. A few models that we have also worked on in terms of dissecting its legal and regulatory considerations. So I think there's no better than Priya to help us explore how returnable grant essentially works in the context of blended finance ecosystem. Over to you, Priya.
Thanks, Rahul. And it's wonderful to be here. So while I will talk about returnable grants, I'll also talk about a blended finance continuum. If it's possible, just to pull up my slides. So we've now been working with farmers and FPOs for a while, and should be obvious that no farmer, no FPO is the same, right? And so what we've done over the last couple of years is really created a blended finance continuum, which has a combination of grants, returnable grants, credit guarantee backed debt, as well as debt, with government schemes built in. The intent very simply is that we meet the farmer and the FPO where they are. So for example, grants work really well when you, for example, want to do training for farmers or want to build capacity or want them to try things that are innovative and experimental for the first time where they may not want to take the risk. Returnable grants work extremely well when there is the ability for farmers to actually take money, invest in a particular input or infrastructure or in a technology, and then be able to pay the money back once they have sold the harvest and have some money. We've now done about 103,000 returnable grants over the last couple of years and consistently see above 90% repayment rates. Those and returnable grants are only kept for those that will never qualify for a loan, no matter what, right? We also work extensively with both philanthropic funders and SIDBI and CGTMSC. We talked about that a bit earlier. And the way our model works is fairly simple. CGTMSC typically provides an 85% to a 90% risk cover to a lender. The challenge with that is the following, which is, let's say there are two farmers, one who has taken a loan before, and CGTMSC doesn't really provide it for farmers, NABARD does. But let's assume that there's an entrepreneur that has taken a loan and another entrepreneur who has not taken a loan. Now, a lender, when given a choice of a 90% or an 85% risk cover, will always choose the person who has taken a loan because he's a known entity. No one's going to bet on the entrepreneur who hasn't taken a loan. So what we typically do is, while we unlock government credit guarantees, we provide a 5% FLTG on top to incentivize lenders to lend, which means there is usually a 20x leverage for any kind of philanthropic capital. What we've consistently seen across multiple credit guarantees is that actually the default amount does not get used. We see less than 0.5% default, which means the money actually remains and can continue to catalyze more and more lending. We also get a commitment from lenders to say that once they have used a credit guarantee for a first-time borrower, that the next time the borrower gets a loan, we waive off the credit guarantee cover because it's no longer needed, and it's now enables lending to another borrower, and so on and so forth. And then ideally, people that we work with are integrated into the formal credit ecosystem. So the intent is to use grants, returnable grants, very, very sparingly, only for communities that absolutely have no ability to get credit, and then use credit guarantees much more systematically to ensure that both farmers and FPOs get access to the much needed credit they need. This model enables us to scale very rapidly. So to give you a sense, the returnable grant is now integrated into Beacon. Beacon is what enables open networks like ONDC and others to operate, which means we can now issue a returnable grant to a farmer in less than 2 minutes. So we have the ability to identify a farmer, understand his or her needs, and then do KYC, very much like a bank would assess a potential borrower, and then transfer money directly into their bank accounts in under 2 minutes. So a lot of what I'm talking about is meant for rapid scale and replication. We already work with 75 odd nonprofits, government entities, banks, philanthropic organizations. And the hope really is that if we can help as many people and as many organizations to really use any or all of these instruments, that would be a big win. We're also co-creating a pre-credit score. For those of you that are familiar with a bank's underwriting process, banks don't really know how to evaluate anybody who comes from the informal ecosystem, very simply because they don't really have a very significant digital or financial history. So we also collect data on other aspects of a farmer. So for example, his skills, his ability to have taken and use government subsidies, his transaction with his buyers or sellers, and we capture all of that data, and we are creating a pool of this data that's available not just to a single lender, but to every lender who's keen to really lend in this space, right? So the pre-credit score almost functions like a public good. If we can just move to the next slide. I wanted to just take one example of the work that we're doing in Maharashtra. So for example, we are supporting 10,000 farmers across 12 FPOs. A large majority of these are women farmers. It was intentional. These are also relatively new FPOs, and therefore we wanted to come in early enough to make sure that we are building capabilities around multiple aspects. So yes, access to credit being vital, but then also their exposure to climate smart practices, climate smart products, tools, technologies. We provide not just training, but also access to infrastructure and inputs. Market linkage was going to be vital. If they can't sell, then what's the point of providing all of these inputs? So we're also linking both the farmers and FPOs to local markets as well as large networks like ONDC. Wherever possible, we also want to ensure that farmers have access to social security. So everything from crop insurance to any and every government scheme that's available, not just in climate, but also in health, livelihood, etc., is systematically unlocked. What we found, and this is a very new project, it's only been a year old, but we've already seen about 97% repayment rates across all of the returnable grants. What drives, so a returnable grant is a zero interest, zero collateral, pay if you can, when you can instrument. So imagine if I had to just distribute 10,000 rupees to everybody on this call, and to say, no pressure, use it however you want, pay it back whenever you can. And if we all meet in a year's time, the question is how many of you would return that money, or you would even remember to return the money. We find that no matter who we work with, and these farmers in particular, we're seeing a 97% repayment rate. Remember, they have no legal obligation to repay. They're still paying the money back. They pay the money back for a couple of reasons. One, because we structure the returnable grant in a way that they can use it. So they typically use it before the sowing season to purchase agri inputs, anything else that they need to really invest in climate smart technologies that they are convinced will work. They pay the money once they sell the harvest. So it's always customized based on the cash flows of the people that we support. Second, there is some social pressure to repay. Typically, returnable grants are administered by local institutions, and therefore there is some sort of a moral obligation to repay. Also, once somebody repays the money, it goes to the next farmer. So there is the understanding to say that if I don't pay the money back, I'm going to deprive somebody else of this vital money that made a difference to me. And some of these factors really end up driving fairly high repayment rates. Ideally, people who've received a returnable grant then get access to credit. We share the repayment data, obviously subject to the farmer's consent with the potential lender. The lender obviously feels very comfortable to know that somebody who didn't have to repay the money has now paid it back and therefore is potentially a good borrower. Again, in this particular context, we were able to use a very, very small amount of money to unlock about 7 crores of lending to more than 1,500 farmers. Average loan size is 44,000. We usually recommend to the farmers or the entrepreneurs that we work with that be conservative in terms of your first loan. It's going to set the precedent for what your CIBIL score looks like. And therefore really customizing even the loan size to the exact requirements of the farmer. The social security bit is incredibly helpful because, for example, things like health insurance, crop insurance, etc., then provide a risk cover to the farmer and then in turn the lender. Everything is coupled with trainings on good climate resilient practices. And so these are multiple training sessions, typically championed by somebody. And then, like I said, as much as possible, every farmer and FPO is linked to markets much more systematically. We have already seen very significant increases in income. There's just one example there of Sita. But typically, for example, we're seeing between 20 to 50% increase in average family income, even within the period of 1 year, even accounting for the fact that things have not been very easy, as you know, in the past year for the farmer and FPO ecosystem. So I'll just pause there and happy to take any questions.
Great. Thank you, Priya, for such a detailed explanation on return on grant aspect that you're working on. And I have one question for you. Uh, what has been key learning so far in terms of implementing blended finance initiatives at Samhita? And particularly in respect of how do you unlock climate resilient capital for farmers and FPOs?
Um, so Rahul, we are designing this for scale, right? But while we're designing it for scale, we're also very careful about contextualizing it constantly. So a couple of learnings. One, all of our blended finance instruments are responsive to the needs of the people that we serve, right? We know, for example, that women don't have collateral. We know that the agriculture sector is fraught with uncertainty. We understand that a lot of the people that we work with really have very, very tiny farm sizes. And so firstly, the design is very responsive to the needs of the people that we work with. But the design is also very responsive to the needs of our lenders and our funders, right? So the reason we're able to unlock the 20x on credit guarantees, or the reason that our cohorts see such high repayment rates, is because we're systematically solving for multiple things that actually prevent access to credit, which means we support sourcing, we support training, we support underwriting, we provide the credit guarantee cover. We also ensure that farmers, in this case, and FPOs, are going to be profitable and therefore can pay the money back, right? So we are very careful when we design an instrument that the needs of the different actors are systematically looked at. Second, we really embed a lot of technology in what we do. We are one of the only organizations that's integrated into ONDC, into Honest. We're now integrating into Vistar, which is the new network coming up in the agri ecosystem. We're integrated into the common service centers, into multiple banks, into CGT MSC, and many, many such organizations, which means that our ability to acquire, underwrite, connect, etc., is very fast and costs almost nothing, because really we use technology very smartly, right? Three, I think your question around how do you ensure that climate smart practices are, again, customized, and that you work with a farmer and the FPO over a period of time to ensure that they're not just comfortable with the process, but also excited about what they're incorporating and what's the outcome. And so typically we've seen projects that only provide inputs without access to credit, access to markets, don't work as well. And so you're seeing in our programming that we're bringing skills, capital, government linkages, market linkages all together systematically to drive this to scale.
Great. Thank you, Priya, for such a detailed response. And it was very helpful. We have been listening to different models, but it's really helpful that we've been listening from practitioners like you as to how these are operationalized on the ground. I think certainly will have key takeaways from our sessions here. I now move Yes. I now move on to our next topic, which is interest rate subsidy model. And we have Ms. Viva Sharma. She is a senior member with Villgro. And Viva, we look forward to your thoughts on behavioral barriers and how interest subsidies would help overcome them. Over to you. Thank you.
Hi, Rahul. Thank you. And thank you for having me here today. It's a pleasure to share, our learnings and experiences at Villgro. We've been implementing blended finance solutions for about 5 years now. And let me just share my screen as well. So at Villgro, we are a technology business incubator where we work at the intersection of innovation and impact. And over the last few years, we've been testing and deploying a range of blended finance instruments, both at the enterprise level as well as the end customer level, which the enterprises serve. So today what I'll do is I'll share a little bit of the learnings from our pilot on interest subvention and how that has shaped our broader approach and strategy on blended finance. What we've consistently seen on the ground is that even when, an enterprise or, a product, right, has a clear financial and an impact value, the access to credit remains a bottleneck. And for enterprises, this issue is mostly because of, their unique products, business models, their longer gestation periods. And for farmers and for, FPOs or the end user community, it is usually because of creditworthiness and affordability, as well as, I think, another additional feature over there, which is the behavioral barriers that are there. So blended finance, the way we look at it is when we are able to target it specifically to the kind of problem that we want to solve, it can actually address the access to capital barrier at both these levels. So the instrument has to match the problem. So in terms of our subvention, it's just a quick structure that I have, I'll walk you through it. So what and before I go there, so what we refer to as interest subvention is essentially, when there is a loan that either an end user or an enterprise has taken from a financial institution. How can, we reduce that interest burden on the borrower? And this we do through, philanthropy. So where the blended finance angle comes in is that, by reducing the cost, we are essentially making that capital more affordable, which should crowd in, the commercial lenders. So in this particular case, we were working with a social enterprise which had an innovation of, a hydroponic fodder unit. And that was, able to provide fresh fodder around the year, even during the summers. And there was a clear linkage between, having access to fresh fodder and the amount of milk yield that the cattle had, as well as an increase in income as a result of that. Along with that, this also, had, it used very little water. So from an environment perspective also, we could see that there was a clear impact over there. So increase in income as well as environment. That's how, this innovation was something that we were keen to get in the hands of the cattle owners. We collaborated with Sangamitra to, enable loans, and the loan was coming in at about 19.5% rate of interest. And our predominant target borrower group in this case were women. So because women are the ones who are, usually milking, selling the milk, taking care of the cattle. So we were looking at them as, the key customer segment, and we wanted to make this affordable for them. So we put up a 10% interest subvention, for this. And the intent over here was that, by enabling the loan as well as putting up the subvention, we are able to match the cash flows that, the cattle owner would get from this product and the loan installment, right? So putting an upfront cost, which the innovation costed about 30,000-40,000, was hard for the cattle owner. But by making it, let's say a 1-year loan period, you were able to match the increase in income because of the innovation to the loan installment that was to be paid, right? So that's how we had structured this. And on paper, it definitely made, the loan more attractive. And we also had women who were very interested. But having said that, I think what our experience was with the instrument was that, while the women were very interested, in practice, the real barrier was from the financial institution perspective as well, where, the risk perception was much higher, for the first to credit women. And the subvention was not enough to de-risk the financial institution. So, the credit did not flow as expected in this particular case. And I think in general, our learning was that interest subvention will work well. It has an important role to play when it comes to, getting the innovations adopted and used by the segment. But we also have to look at how we are solving for access before we solve the challenge related to cost. So when we are solving for multiple problems, just this one subvention was not enough in this particular case. And we are now trying that by coupling it with either a subsidy where, the product cost was reduced and with a first loss guarantee. so that, the challenge of access to capital was also solved. So those were essentially our learnings, when it came to this particular pilot. Overall, I think the 10% or less than 10% rate of interest was definitely attractive for the farmers. But in this pilot, we had other challenges to solve for. So that was something that I wanted to share with all of you.
Great. Thank you so much for taking us through to your presentation. And we now, in the interest of time, we now move on to our final speaker, Kritika. Kritika, over to you for your thoughts on CapEx subsidies and how exactly does it help in easing farmers' adoption journey. And at the end of our discussion, we'll have questions for both Vibha and Kritika, and then we'll quickly take up the legal and regulatory portions as well. Thank you again, Vibha. Over to you, Kritika.
Yeah, I'm trying to figure out how to stop sharing my screen.
We'll do it from our end.
Okay.
Thank you. Mukesh, can you just help us with that?
Yeah, and while we're waiting for that, I just wanted to kind of add that,
Sure.
for us, because we work at both the enterprise and the end user segment, right? Our observation in terms of where this instrument would be most relevant would be, when we have, like, for example, at an enterprise level, where they are at, a commercialization stage, proper paying customers, and, the de-risking has happened from that perspective. We come in to reduce cost because typically the lending for the early stage commercialization is from NBFCs, right? So which are high rates of interest. And in terms of the end user segment, mostly when the value of the interest subvention, right, is also significant. So that was the other learning that I wanted to talk about, was to say that, let's say it's a small 20,000 rupee loan, the subvention is not enough to kind of bring in a behavioral change. But can we, when it is a loan like for an FPO for a substantial value of 20 lakh, 30 lakh rupees, then the subvention does have a significant value. But over there also, I think support through technical assistance and some of the other, mechanisms that are available are critical to actually make that subvention, get to that outcome that we want, which is of increased impact, increased climate outcome, all of that, and mapping the instrument to the different stages. And that's what we are doing currently in the facility that we are launching. So but happy to talk more about that with the individuals. Thank you. Been able to stop sharing now.
Thank you, Vibha. Well noted. We now move on to our last theme, and we have our speaker, Ms. Kritika, to share her insights with us. Over to you, Kritika. Thank you.
Thank you, Rahul, and a very good afternoon to everyone. It's a pleasure to be here. I next 10 minutes is our interventions in the state of Orissa that we had carried out through the support of the IKEA Foundation, and here we were able to successfully demonstrate jointly with public sector financial institutions and private sector financial institutions how at the back of philanthropic capital and the support of local CSR funds we were able to unlock commercial capital from a few banks. So of course I will delve a little more into what these blended finance models were, and perhaps we can also go on to the next slide. But what you can see here is essentially two technologies that we piloted. One is a solar powered aeration system and a solar refrigeration system through which we were able to extend the services of these technologies to 1,000 fish farmer, all of them women. And through these especially it was, and I'll bring in the aspect of the lower capex very shortly here when I say that the upfront capital cost of these technologies is something that the end users are extremely sensitive towards, especially when the traditional way of say doing aeration in the pond in which fish is being cultivated. The traditional way of carrying out this aeration is basically through branches of trees or even through swimming. So when you have to really prove to the final adopter what the cost economics is and why they should be adopting a particular technology, they become extremely sensitive about the upfront capital cost, and also that why should they be spending this money? Isn't there a subsidy structure already available, and so on and so forth. So what I will do over the next few slides is take you through the structures that evolve. So what you can see on the screen is, sorry, can we go back? Yeah, is the one for solar powered aerator cum feed dispensing system. This is something that we did in the districts of Kalahandi and Kirkona and Orissa, with two fish farmer producer companies. We had the support of a public sector bank and a regional rural, some kind of evidence along with them for the techno-economics of this particular technology. Sorry, yeah, okay, we are back on. So if you see the circles in the outer periphery, you can see that there was farmer contribution, very low percentage of bank loan contribution is what. Sorry, Rahul, are you saying something?
Yes, Kritika, we had lost you in between, so we couldn't
Okay.
exactly hear what you said in past 2 minutes. So maybe you could just recapitulate back again for us.
Okay,
Thank you.
sure. I'm happy to do that. So, what I was basically discussing is the structure of the blended finance, model that evolved, where you can see that there is an element of farmer equity. We have an upfront discount from the vendor, especially because it was women farmers that we were targeting. We were, of course, able to unlock the bank loan, which you can see a very small percentage here, at the back of some local CSR fund contribution, and this really helped banks to take this exposure that we wanted them to take for the very first time. Of course, I can talk about how this technology is going to get used, but I think what is more important is that there are some early impacts that we are also able to ascertain, where with the use of this technology, the weight of the fish, the productivity of the fish also improved, which again then talks about how this also led to improvement in livelihoods for the final adopter. Very quickly, if we can go on to the next slide, a very similar model that evolved was with regards to a solar powered refrigeration system, where again we had this almost the same elements of a CSR fund contribution, a farmer equity, and a bank loan. Slightly higher here, where we did this with the public sector financing entity under an existing scheme run by the government of India, again to impact and help women farmer producer organizations in adoption of this particular technology. So perhaps we can also pull down the slide, but what the two things that I wanted to specifically highlight is um, the support of the CSR funds in this case and the upfront discount really helped banks reduce the exposure that they were taking, especially because these were first of its kind transactions where they wanted low exposures. They did not want to take on that risk upfront, and really the presence of this particular element brought that risk down, that perceived risk down. Of course, we were able to also provide technical assistance to help them develop these new financial products within their frameworks, to understand what function these technologies were serving, because that's another thing that we felt that banks had a hard time to understand. What is the functional value add of the technology? And the third thing, the techno-economics. What is the commercial viability? What do cash flows look like? And how are repayments going to be made? So especially in terms of technologies where we're looking at early stages of product adoption and first of its kind transactions, it was very important that the interest burden, the EMIs and the exposure are kept at a minimum. But what we're now hoping to do in the next phase of our project, where we're also looking at the states of Assam, Bihar, Jharkhand and Orissa, is that at the back of these transactions, using them as potential demonstration pilots, we do intend to increase the amount of exposure that banks will be taking. So of course, we would be requiring the support of philanthropic capital, because especially because there is lack of a policy framework at the central or the state level, and I think there would be a continued need for this element to come in. But of course, an increase in the exposure of the bank loans would be very welcome at this point of time. So I will stop here. I know we are also short of time, Rahul, but also happy to answer
Yes,
questions.
sure. So I had 3 to 4 questions for you, but maybe I think in the interest of time, I'll take up one.
Sure.
So from a design perspective, Kritika, how do you ensure that CapEx subsidies complement rather than crowd out financial institutions' lending appetite? And, and how can,
Right.
CapEx subsidies be structured to reduce initial EMI burdens? I think these are two
Right.
quick takeaways I would like to have from you. Thank you.
I think the first question I'll answer from our experience with the technical assistance that we are providing to the Ministry of New and
Right.
Renewable Energy on the PM Kusum program, where actually you can see that there is a very clear subsidy already available from the center and the state. But what we've come to notice, and a very important aspect, is that the bank as a commercial entity needs to have enough into bite into, right? And for that reason, what
Right.
we observed with PM Kusum was that combined at the center and the state level combined, there were subsidies as high as 90% that were being offered, right? So that really left nothing for the bank to take an exposure on. So I think this is something we need to be extremely mindful of while creating these blended finance structures. Is that it needs, while we are trying to reduce exposures, also contain the AMIs, the interest burden for the end user. It also needs to be having some kind of commercial viability for the bank to take as an exposure. These are extremely small ticket size transactions, and of course the transaction costs, given that we are talking of last mile entities, end users, are extremely high, the transaction costs. So this is something that we need to be mindful of. But as far as these technologies are concerned, I think there's still some more way to go. Rahul, if you can just repeat your second question, I can attempt to answer it.
Sure. So the second question was from a design perspective, and how do you ensure that CapEx subsidies complement rather than crowd out the lending appetite? And the earlier one that I had asked you was on the CapEx subsidies structuring to reduce EMI burdens. I think these were 2 questions I had for you.
Yeah, so I think I did answer the first one on the EMI
Yes, you did.
burdens. Yes,
Yes.
on the EMI burdens, I think one thing that we conscientiously did during our interventions is to select specific financial institutions. And I know that many of us do not have the luxury of doing that, but perhaps select and work with financial institutions that already offer a low rate of interest so as to contain that interest burden. And I'll be extremely honest, we had a very tough time doing that. We had a line of NBFCs which wanted to work with us, but the interest rates were as high as about 18 to 25%, which was just not viable, for the small and marginal category of farmers we were intending to work with. So this is something that we did. Of course, I know the other speakers have also spoken about other de-risking instruments such as interest subvention, which can potentially also be applied, from one context to the other. But I will pause here with my thoughts for now.
Thank you again, Kritika, for your responses.
Thank you.
Now we'll go on with our closing remarks. So thank you all to the speakers for their valuable contributions. As we have seen today, blended finance for climate smart agri is not just a capital solution; it's a design challenge. It's a compliance challenge as well as an opportunity for partnerships. So each structure we explored, whether it was subsidy, guarantee, returnable grant, risk sharing, or capex, it comes with a lot of convergences as well as divergences in law, both from legal, operational, and behavioral nuances. So I think while we have exceeded our time limit, I think we'll try to fit in a question or two. So we'll take up at least 1 or 2 questions. Sahir, can you help us with question identification that we can have for speakers, and maybe we can have 2 more minutes to answer those questions, and then we'll quickly wrap up our session.
Yeah. So one of the question that is from Pavitra, this is generally to all the panelists. So she's asking that there was a constant reference to philanthropic funding. Keen to know the experience on how receptive the philanthropic donors have been for blended finance projects. So if any But maybe Richa, you
I
can
think,
take this up.
sure. Yes, I think Risha would like to take this question. Over to you, Risha.
Well, if it's a fundraising question from IKEA Foundation, there is a different response. I'll give a more general
I
response,
know. Yeah.
which is that it really depends on the donor and where they are situated, what their geographic location is, and also what their mandate and strategy is. It's some donors are strategic, some are less strategic. So you have to be familiar with their strategy. What I have seen is that in the impact investment category of donors, there is again. There are some donors who might be able to lift slightly higher levels of risk. There are some donors who would expect a philanthropy like ourselves to come in, take on the risk with grant capital and then come in, even though they are impact investors. So I think it's a bit of a very contextual depending on that particular donor.
Right. Yeah. Priya, your thoughts? Maybe.
Yeah, actually, we've
Yes.
blended capital across multiple donors, everybody from USAID to Walmart Foundation, 361 Foundation as well. A lot of them came into credit guarantees. We've now had about 20 different funders for returnable grants. And so I think the simple trick is fully agree with what Richa said, which is as long as you can customize it for what the donor is looking for. These are not very hard instruments, right? A returnable grant gives you a 5 to 7x leverage. A credit guarantee gives you more than a 20x leverage. So as long as you can customize it, it could be fairly attractive to donors to come in.
Great. Thank you both for your responses to the question. As we close the
Rahul,
session,
if
I would.
if I
Yes.
could
Sorry.
potentially add as well over here. So I think,
Please
yeah,
go ahead,
that has
please.
been the experience that we've had as well. So we also have a range of philanthropic donors, right? Both from domestic CSR to international foundations, which have been, very receptive to a blended finance. But what we also felt that, having it as a facility and having an impact first approach, right? Not a finance first approach, right? So what we're doing is not a financial structuring to say, how do I reduce interest cost or how do I reduce risk, but to say that, how does this lead to an impact creation in the end, right? That has been how we've been able to, actually get through to the donors. So we're both in our Powering Livelihood program, now in our new facility that we're launching, we've even partnered with AVPN with a mandate of 100,000 farmers to be reached with climate smart agriculture. So in all of those, we put in impact targets, right? To say that we are going to improve livelihoods of 20,000 people, right? That has been the selling point. It's not the financial instrument itself.
Understood. I think, the more we brainstorm and interact with industry players like you in the blended finance space, the more we have we as lawyers would understand the more operational nuances of how this has to be executed. Of course, we always look through a legal and regulatory lens, but understanding it from a practitioner's perspective also helps us visualize it even better. So I think more we interact on these structures or brainstorm, the better we are going to further the cause that blended finance ecosystem espouses for. And with this, I would like to close the session, and I would like to thank Ganesh, Richa, Jay, Priya, Vibha, Kritika, and all of the members for joining our call for our webinar. We hope today's discussion has sparked some meaningful partnerships to scale climate adaptation through structured capital flows, and we look forward to more such fruitful interactions with you all. Thank you again for joining.
Thank you all, everyone.
So much.